Hello, my name is Ben. I'm an online trader. I trade the online markets and I've been doing trading for the past 7 years. I started with crypto trading, then I ventured into Forex, and now I trade every other market that is available to be traded online. So today, in today's lesson, we are going to cover how to set up a trade, how to open a broker account, how to work with MT4 or Metatrader 4 and Metatrader 5, how to configure the charts, where you log into the MT4 and then you begin trading, how to do the trade entries both for buy and sell, and the types of entries as well. We have what you call market execution and pending trades, pending entries. And lastly, we look at how to, the complete trade setup where you can be able to incorporate the stop loss and the take profit after entry or before entry or during entry. So we're going to cover all that. But before I go into anything else, I'd like to remind you that this is a recap. Just as a recap to what we've covered so far, we've looked at introduction to Forex, introduction to online trading. We've already covered that. We've looked at how big the market is, the types of markets. We've looked at margin trading, and so on and so on. So we've introduced the whole concept. So today we are going into more practical way of trading. So let's dive in and get started. Welcome to Blockchain Academic Hub, where skill meets opportunity. Okay, so how do you really open a broker account? I've mentioned before that as an online trader, as a retail trader, we trade the market through a Forex broker, which is like an online bank. Okay, so you can't trade directly on the market unless you are a big player on the market. But as a retail trader, as an individual, you have to trade through a Forex broker. So first and foremost, who is a broker? This is an online bank that gives you an opportunity to trade the markets. They give you leverage, they give you margin for you to be able to play on the market as if they give you borrowed money, like we mentioned already, margin trading. Okay, so a broker is an online bank, so to say, in a layman's language, without going into too much definition and illustration of what a broker is. So we have different brokers. We have what you call A book brokers and B book brokers. We have what you call the ECN brokers. We have what you call the STP brokers. So we have a topic on them, okay? Completely talking about Forex brokers and Forex brokers alone. But for now, I'd like you to know that for you to trade, you will trade through a Forex broker. So you'll get what you call a broker link, where you'll open an account with a broker, give your details, upload your details, your name, your email address, your KYC and everything, know your customer, attach your ID, attach your proof of address, documents and everything, because they are just like a bank. So they need details and information from you. So you'll receive a link that will allow you to open a broker account. Immediately you do that, then the next step is for you to upload the documents. You'll begin by uploading the ID, the national ID documents, whatever that will be able to prove to the broker that you really exist. You're an individual, you're a human being, you're not a robot. And then after that, you attach another proof of address, where you'll be able to verify to them that you really exist and you live in a certain country or in a certain locality. So that way, that will complete the KYC process. And then a good broker in this case is one that will be able to verify this documentation very fast, so that you can begin trading the next minute. So you will do that, and immediately you finish the KYC procedure, the next step that you will do now is to open a trading account. Remember, you were opening a broker account. You're opening an account with a broker, introducing yourself to the broker. But then this broker, once you're verified as an individual, as a human being, or as a corporate, then now you go ahead and open a trading account. We call them MT4 trading accounts or MT5 trading account. MT4 stands for Metatrader 4, which is a platform where we trade on the phone, okay? And you'll be able to download it on Play Store if you're using a phone, on Play Store or App Store, or you can also download it on your laptop or your PC. It's downloadable, so you can download the application. This broker will allow you to download this application, and you will log in with the trading details that you've received from the broker. So after opening an account with a broker, next thing you do is to open a trading account with the broker. Now, where you'll be given the login details, where you can now log into that MT4 or MT5 and begin trading with this broker. So basically that's what you do, and a demonstration has already been done. So where you can be able to see how an MT4 looks like, you're able to see that, you're able to, log in. You'll now log in with the details that you've been provided by the broker. And at this point now, we go into how you can configure this MT4 after login. What next? How do you pick the trades? So you can first and foremost look at the charts, see how the charts just look like, because the next topic now will be looking into how to look at the charts and analyze. Okay, but for now we're just looking at the introduction to MT4. This is the MT4. Okay, this is where you log in with the broker info. After you log in, this is the interface that will be able to show you that this is where you trade. You can see the charts, you can see the pending entries, you can see the trade history. And that is what an MT4 is all about. So next now, let's look at how to trade, okay, the trade entries. If you want to pick a trade, for example, let's look at Euro USD. When you click on that trade, on this Euro USD, it will be able to redirect you to the window where you can now pick the buy or the sell. If you want to sell, maybe out of analysis that you've seen you want to sell, then you click sell. Just as you can see, click sell. If you want to buy, you do what? You just click buy. When you do that, you've traded. So we're assuming that at this point, you've been able to analyze the market, reach the conclusion that you want to sell the Euro USD. So when you get here now, once you click on the currency pair in question, in this case it's Euro USD, all you have to do now is just do what? Click sell. But there are a few things you need to note before you do that, before you click sell. Number one is what you call the lot size. The lot size, as you can see, the lot size, it starts from 0.01. We will look at that later on in terms of risk management, but you can edit the lot size. As it is now, it's 0.01. As it is now, you can change it to 1.00. You can change it to 2.00. You change the lot size based on your account balance. How much money do you have on your account? So if you have $1,000, then it's recommended that you can use 0.1 as the lot size. If you have $10,000 on your account, then your lot size can remain at 1.00 as the lot size. We'll be able to see what this is all about, the lot size, during our risk management class. But for now, you take the 1.00 lot size, and that's what you will trade with a $10,000 account. So that means if you have $10,000 on your account as it is, then you immediately click sell because your lot size is in order, because it's 1.00. So when you sell, then now it means that for every move in the market with this 1.0 lot size, every move in the market is giving you $10. That move is called a pip. Again, we will define that when the time comes. So every move, every step in the market, that small step is called a pip. So every move in the market is earning you $10. That also means that if the trade goes against you in analysis, then you are losing $10, okay, as the trade is running. So that is what basically it means when you click sell, just like that. You will do that based on one, your analysis says sell. Number two, before you click sell, make sure that you double check to ensure that your lot size is in order. And then now you enter the trade as a sell. When you do that, that trade entry type is called market execution. You've not waited to set a trade where it will be picked. No, you've entered the market at the current market price. Where the market is now, that's where you enter the trade, and that's how you enter using market execution. It's also called instant execution. You've entered the market on the go. When the market is moving at that particular point, that's where you enter the market. So that makes type 1 in terms of entry types. So we call that market execution. So if you enter the market with market execution, what about the other way of trading? What is the other type of entry or entering the market? We call it pending orders. And that's what I will take time with so that I can make everything clear to you. When we talk of pending orders, apart from instant or market execution, here it means that you will go to the currency pair in question. You've analyzed the market. you realize that this market is moving up, but it will hit some level of resistance, and at that point, the market will begin coming down. You expect that the market will begin selling once it hits a ceiling or a resistance or a point in the market where the market has to reverse. Now, when that happens, when you anticipate that through analysis, it means that you're looking for a sell trade in the future, or in the next 5 minutes, in the next few minutes or so. It doesn't really matter. What it matters is that the level at which you expect the market to turn back. So that level, we call it resistance. Again, we will look into that when we get to market structure, which will be a topic on its own. But for now, when the market goes up, it gets to a certain level, you expect that it will hit a ceiling or a resistance and begins trickling down. You can set what you call a sell limit. So under pending orders, we have 4 terminologies, or we have 4 trade entries. Number 1 is what you call a sell limit. A sell limit. This means that the market is here, it's going up, it's currently buying, but you expect that by the time it gets to a certain level, the market will turn back on itself and it will begin selling. When it begins selling, at that point, you can set what you call a sell limit at that price, at that market price, at that point. So it's moving from 1.3. You expect by the time it gets to 1.4, it will begin selling. So you set what you call a sell limit. Number 1, sell limit, where it will hit there and it can't go beyond that. You're limiting, in layman's language, you're limiting the market to go past that you get there and begin selling. So we call that a sell limit. Of course, in the natural, you can't limit the market because you're just an individual, you're just a trader. But based on analysis, you can actually predict the market will get there and limit itself and begin selling. So we call that a sell limit. That, the opposite of it, is a buy limit. It means that the market is coming down currently. You anticipate that it will hit a certain level on the market, which is a support, that price can't go beyond it, and therefore it will hit that level and bounce back, okay? Begin going up, go back to buying. It is currently selling, it will hit that level, and then it will do what? Begin buying. So when that happens, that means you will set what you call a buy limit in the current selling market. So the price is 1.4, let's assume it's 1.3, it's coming down. You anticipate through analysis that once the market gets to 1.2 as the price, the market will bounce back and go up and begin buying again. So that is called a buy limit. How do you get to that conclusion? Through analysis. You can look at the past market and realize that the support is at 1.2 or the resistance is at 1.4, and so at the support, remember these terminologies I'm using, we'll be able to discuss them when you go back to the charts, that we have what below the market, you know, where the market bounces off to go back up, we call it support. It's like a support, something, a foundation that is holding the house. And then at the top, we call it resistance. Is like a roof where price can go beyond. At times it can go beyond, but then in most cases that price has to respect that roof and come back down. So the roof or the ceiling is called resistance, and the bottom of it, or the foundation, is called support. So on support, when we talk of pending orders, on support, you have to place what you call a buy limit. On resistance, where you expect the market to hit and begin dropping, we call that a sell limit. So I hope you've been able to see through the demonstration that you can set a buy limit and a sell limit in the market. And what that does as an advantage is that you don't have to stay on the chart the whole day. You don't have to stay on the chart the whole time. You can actually come, look at the market, see where it is now, see where it's headed to, and you will be able to set these limits and go do other things, because these trades will, you know, trigger themselves. Once price gets there, the trade is triggered and you go into profit. Once price goes there to the support, it will trigger the buy limit, go into profit, or whatever it will do. You don't have to be on the charts 24 hours, 7 days or 5 days a week. So that is what you call pending orders. Just for the two, remember I mentioned there are 4. So far I've only mentioned 2. Are they the perfect ways of trading? Yes and no. It depends with the type of trader you are. It depends the time frames that you're using. It depends with basically the type of trader. Are you a swing trader? Are you a day trader? Are you a position trader, and so on and so on. Number 3 now, under pending orders, remember, don't forget there are 4. So number 3 is what we call buy stop. Number 4 is sell stop. Buy stop means that the market is going up. It has already gone past. It's like buy stop. You can look at it as a bus stop. Okay, where the price is coming, you expect that when price crosses this level and gets to that point, it will be able to continue buying. So you can put a buy stop there, that please, when you get to this bus stop, wait for me, let me enter the bus as you keep going. What do I mean by that? Remember, I've already mentioned support and resistance. We've already mentioned the floor and the ceiling or the roof. So what happens is that at times the market can break through the roof. If the market breaks through the roof, technically, you expect that roof will now become the floor or the support. So once the price breaks through, pierces through the roof, then what happens is that you expect that this price will keep going up, which in most cases does not happen, but sometimes it does. That once the roof is broken into, that roof becomes another floor. Just like you have floor 1, floor 2, floor 3. You're in a story building. You are on the ground floor. Once you break through to the first floor, that first floor becomes your support. So the second floor becomes your ceiling. So that's what it means by a buy stop. That you are on this level. Price is still oscillating between the roof and the floor. And once it breaks through your roof, you expect that it will keep going up. So what people do is that they can set a buy stop at the top of the roof, which technically we call it resistance. So you set a buy stop at above resistance, as a little distance above the resistance. So once you do that, you expect that the market, once the floor, the ceiling or the resistance is violated, then the price will keep on going up. So you set a buy stop above resistance as a pending order, where you say, I don't have to wait, for the market to do what it does. I want to set a buy stop above resistance and I let the market go, and that's what you do. So technically on the charts, you can see that you can be able to set, draw your resistance here, and you'll be able to put your buy stop above resistance. As price breaks through the resistance, picks your trade and goes into profit. So that is called buy stop. The next one, or the last one, or the opposite of that, is a sell stop. Just like we've already mentioned, this means the market is already going down from above, and then it will get to a level of support, and you anticipate that this market will break this floor today. So it will break that floor, it will break that support, and once that support is violated, then you expect that the market will keep going down. It will keep going down. So you can set a sell stop a few or a little distance below the support. So we call that a sell stop, where the market will pick you on that level as at a sell stop and go into profit with you. Does the market always do that? That when it breaks support, it sells, and when it breaks resistance, it keeps on buying? No, but at times it does. So it depends with, different levels, decisions that you've made in terms informed by your analysis and your trading style, where you'll be able to say, okay, at this point, I want to set a buy stop here. I want to set a sell stop here. You are informed by the decisions you've made, because the key thing here again is analysis, where you'll be able to know what to do, how to enter the market. Do you want to use market execution? Do you want to use pending orders? And if you're using pending orders, then how do you trade? What type of pending order do you want to use? Do you want to use sell stop, sell limit, buy stop, buy limit? What type of pending order do you want to use? So basically, that's how you do when it comes to what you do when it comes to trade entries, the type of entries that you want to use. So I've already told you that if you are day trader, most day traders, what they do, they enter the market with market execution. They set their stop loss and take profit, because that's the last thing I'll mention for the sake of today's call. And then now you'll be able to determine how far the market will give you profit, how much profit do you expect or anticipate from the market based on analysis. So you don't just set the targets out of greed. You do it as informed by price action or the type of analysis or the type of move you're expecting on the market. You don't expect much, you don't expect little. Your expectation is defined by your analysis. And that's why the skill can never be overemphasized. On everything that we do, we're informed by the skill. Remember that trading is risky, but the risk is inversely proportional to the skill levels that you have. If your skill level is wanting, then the risk will be high. But as you develop your skill, then the risk will go down. And that is when you turn into a profitable trader and your profit will become consistent. You become a consistently profitable trader on the market. So basically those are the trade entries that you can be able to do on your MT4 after you log in from the broker chart, and then you begin, from the broker platform, you begin trading, and you trade using those two major types of entries: instant execution and pending orders. So lastly, the last thing that I will mention, just as a form of trade setup, is that your trade cannot be complete without setting the exit points. We call them the exit points. So you either exit the trade in a loss or you exit the trade at a profit. So there are two exits, therefore: profit or loss. So then for the loss, it means you are out of the my balance, my equity or my account balance. I have $10,000. I'm willing to lose $10 per trade. Out of $10,000, I'm willing to lose $10 per trade. Or I'm willing to lose $100 per trade. $100 out of 10,000, that is 1%. So you have $10,000 and you're risking $100. That's just an example. It's not what should always happen. It means your risk is that before you enter the trade, you define your exit points. Say, if my analysis is wrong, I'm willing to lose 1% out of my entire balance. So 1% of $10,000 is $100. So you set your stop loss in a way that you can only lose a maximum of $100. So that when you lose that $100, you still have $9,900 on your account to trade. Because trading has three goals. In trading, we have three goals. Goal number one is what most people don't know. Goal number one is to protect your capital. Goal number two is to make profit. Now you realize that amateurs, mostly their goal number one is to make profit. Goal number one to a professional trader is to protect capital, because if you don't have capital, you will not trade tomorrow. So you have to have your capital with you. If you lose it, all of it, then you will not be able to trade tomorrow. So goal number one to a professional trader is to protect your capital. Goal number two, to make profits. And goal number three is to protect both the capital and the profit that you've generated so far. So three goals. They go in that order. You can't interchange. If you interchange, you will regret. You can't make making money in trading to be your number one goal. Your number one goal is to protect capital, because without it, you'll not be able to trade tomorrow. So setting a stop loss is very, very important. I've seen traders, and some of them say, I don't use stop loss, and I respect their decisions. But as far as I'm concerned, it's only stop loss that will be able to help me protect my capital. That I'm willing to lose only up to this amount of money. I'm willing to lose up to 1% of my account. Remember, in the first call that we mentioned, in our first lesson that we mentioned, we told you that you'll be able to set a good strategy is one that you're risking little and you're going for more. You risk 1%, you go for 2%. You risk 1%, you go for 3%. You risk 1%, you go for 5%. So in that case, you can have equal trades of losing and winning, and you'll still be profitable on the market, because you have more wins in terms of percentage than the losses that you've generated so far. So without going into much detail, we will be looking at risk management later on, in terms of how you can set your risk to reward ratio, how you can set your stop loss and TP and all that. But for now, just for the sake of mentioning that we work with a stop loss. So in this case, how do you set your stop loss? Your stop loss, if it's a buy trade, it's going to be below entry price. Buy trade, it's going to be below, the stop loss is going to be below entry price. So you've entered the trade, a buy trade at 1.3. Your stop loss, therefore, will be below 1.3. So it's going to be 1.3 minus some pips, some distance from entry. So it's going to be below. For now, we're looking at trade anatomy where we just mentioned it's going to be below, not above. Buy trade, stop loss will be below, and take profit will be above. Why? Because you expect the price to keep going up to give you profit. So therefore, buy trade, stop loss is below, and take profit is above. So in the next call, we'll be able to show you now how we can do the calculations and be able to determine, okay, my entry is here. Where exactly will my stop loss be? Where exactly? For now, we're just mentioning that it's going to be below. For a buy trade, stop loss is going to be below. How far? We will determine that on our next call. But for now, it's going to be below entry. And then take profit, where you say if the market keeps going up, I expect to exit the market here because it's a buy trade. You expect the market to keep going up, so take profit will be above. How far above or where exactly, that will be able to determine that on our next call when we are going deeper into analysis and trade entries. But now, just for the sake of mentioning, your stop loss will be below and your take profit will be above because you're buying. Because in buying, we expect the market to go up. Buying, we call it, it's a bullish market. Bullish market, like a bull, with the horns, it pushes, if a bull was to attack you, it will push you up. It will make you fly, it will attack you and throw you up like that. But a selling market, you expect the market to go down. So if the market is going down, you expect the market to go down. So your stop loss will be above the sell entry. Stop loss above. How far above? We'll determine that on the next call. And then your take profit will be below the selling price entry because you expect the market to go down. So it will go down. How far down? We'll determine that on our next call. Why? We call that a selling market, and it's also called a bearish market. A bearish market is that of a bear. When a bear attacks you, it attacks you with its claws, pushing you down on the ground. So we call that a bearish market. But a bull attacks you while it's lifting you up. So I hope you understand the two now, that we have a bullish market, which is a buy market, and a bearish market, which is a sell market. And now you know where to position your stop loss and entry on both trades, both for sell and for buy. So that's basically what it is. And so we've mentioned in part lot size today. We've mentioned in part stop loss and TP. We've mentioned in part entries. We've mentioned the types of entries. We've mentioned MT4. We mentioned about a broker. We'll be diving deeper into each one of these items one by one as time goes by. But for now, just know that this is an introduction and this is what you expect to get. We are not going to provide all these online during these calls because everything that we've mentioned, it's all inside the academy. Because when you get there, and you can actually go ahead of these calls and be able to dive into the presentations, into the teachings. You get the details, get the skills. We work together, enter the market. The faster you finish, the faster for you to enter the market. You begin trading together. It becomes something, a community, a community of traders. That's what we are looking into. We are looking to have a family, a community of traders where we trade together, mentor each other. Can you imagine now if I'm doing this face to face with you? We're trading together. We're looking at the markets together because you've gone through the courses. Because some of these things, I'm giving them as an introduction. But once you go through the academy, you understand everything. I tell you, okay, pick this trade. This is what we are trading this afternoon. We're trading this during the London session that just finished. We're now going into the New York session. This is what you'll be trading. We'll be focusing on that. Let's set a trade, a pending order on Euro USD. Let's set a buy stop on USD CHF, and at this price, and we expect the market to move this much, or we have news in the afternoon. Let's stay out of the charts for now, or let's do this. Let's talk about NZD. Let's talk about AUD, and that's what we'll be doing. That's how interactive and how much fun you'll have when you become part of us. A trading hub, apart from being an academic hub, we're also a trading hub where we meet together either virtually or physically, because we have an office location where we meet together and trade together. And you're far away from Nairobi, then we can do this virtually together on a Zoom call, because we're going to have weekly Zoom calls where we look at the markets, look at the market outlook for the week, look at what we expect the market, where we expect the market to be the next minute, and pick those trades. We have daily calls where you learn to trade and trade with us. You know, the trades we are taking is what you take as well, and we have signals as well. Everything combined without charging you an extra dime. This is what we are inviting you to do at Blockchain Academic Hub, because this is where skill meets opportunity. We have an opportunity for you. All you need is the skill, and we are providing the same. So why not take advantage of that? Okay, so that will be all for today. And once again, my name is Ben, and we will be happy to have you at Blockchain Academic Hub, where skill meets opportunity. Thank you so much, and I'll see you on the next call.